So
Yeah.
I appreciate that. That's good stuff to keep in mind, Arn. At LifeBridge, we're kind of we're changing our focus slightly. We've traditionally gone after Rocky Mountain markets that have really high growth, both population, which then pushes rent growth up higher. Cap rate compression has been phenomenal and still is compared to some markets around the country. The Southeast would be another area that you're very familiar with that has some of the same tailwinds. But I think there's an opportunity for us to be a little bit more judicious and go after some projects that have a little bit higher yield. When we say that for the average investor, that's higher cash on cash return. So maybe we're not baking in quite as high of an exit multiple, but we're buying projects that have in-place cash flows. I'm curious for your thoughts on that strategy as somebody who looks at a lot of different offering memorandums and how you're adjusting your own allocations moving into 2023.
Great question. And first, let me just say, every investor is unique, right? So each investor has to kind of figure out for themselves what approach, what strategy works best for them. So people who are in different stages of their lives may need different kind of approaches to investing. So for example, somebody who's 30, starting to enter their peak W-2 earning years, perhaps they're more concerned with growing equity than cash flow. On the other hand, someone who's 65 may be more concerned with cash flow over equity growth. So one size doesn't fit all. I think in this kind of market, there is a lot of wisdom to going towards stronger cash flow deals with perhaps less upside. But if you give up a little bit on the upside, I think with the cash flow, it provides some level of security. And typically what I've seen in down markets that have gone up more tend to drop down a little bit more, where more stable markets tend to drop less when things go bad. And albeit there's no free lunch, right? If it's going to jump up like a rocket during a boom, it's probably going to be a little less stable when times turn a little bit rough. And similarly, a steady as she goes type market offers protection on the downside. So one great thing about being a passive investor is you have this smorgasbord of potential investments that you can make, right? So you can really kind of tailor your portfolio and diversify it in a way that makes sense to you. So you can diversify by geography, you can diversify by class, you can do a few more speculative deals, a few more steady as she go deals. And so I think that's really nice option for a passive investor to be able to kind of pick and choose and create the portfolio they want.
Yeah. I think that's really important to highlight is know what your goals are. Begin with the end in mind. And then that will inform what level of risk you're willing to assume and what level of growth you need to achieve those goals. I'm generally a fan of slow and steady wins the race. So
definitely slow and steady will win the race. And, we kind of hear people talk about go big as soon as you can. And I understand that philosophy. On the other hand, I had asked people to consider there are benefits to kind of foundational steady growth and gaining experience in your investing career as you take on bigger and bigger deals. So I'm definitely more a slow and steady guy than shoot for the moon. The way I describe my investing philosophy is line drive base hits over 5, 10, 15, 20 years. You do that, you're going to win. I don't swing for the grand slam. I don't swing for the home run. I'm just happy getting those base hits, seeing my capital work, seeing it grow, produce some cash flow, and just over time building that financial security and ultimately freedom. When people get too far out in front of their skis, that's when problems happen. And I was an investor during the subprime crisis, the Great Recession, whatever you want to call it. And certainly that hurt the value of my assets. But mainly, I didn't lose everything. I didn't lose my portfolio. I was able to weather the storm because I leveraged the properties properly. I had cash reserves. And when I came out the other end, I was glad I kept the properties, and now they're worth more than they ever are. So I'm definitely a proponent of slow and steady and building it in a foundational manner.